Welcome to the Me and Money podcast, where your hosts and certified financial planners, Matt Fizell and Elliott Appel, share their thoughts on hot topics, important concepts, and real-life stories in personal finance. Hear from Matt and Elliott as they share lessons learned in their own financial journeys and those they've witnessed throughout their careers while helping clients. Have a question you'd like to hear discussed on a future episode of the podcast? You can reach out to Matt or Elliott or drop your question at the link listed in the show notes. Before we get to the episode, we'd like to remind you that while both Matt and Elliott are financial planners, they are not your financial planner, and this podcast is only intended for educational purposes. For full disclosures, please be sure to listen to the end of the episode or check out the show notes on your favorite podcast platform. Now, on to the show with your hosts, Matt Fizell and Elliott Appel.
Welcome back to another episode of the Me and Money podcast. Elliott, it's not the 50th episode, at least I don't think it is, but we are going to talk gold today.
Ooh, have you been bitten by the gold bug?
I haven't, but I know a lot of people have, and I've gotten at least a couple questions from friends and family. Not from the wedding this time, though. I was at a wedding this last weekend. There were no gold questions there, but yeah. We're going to talk gold today. So I know we didn't talk too much about it before we recorded this podcast, and we like to do that just so that we can learn about each other's opinions and feelings on it. So I'm going to start with you, Elliott. When you think about gold as an investment, where do you go from there?
My immediate reaction is I can't really wrap my head around it. And I'll expand on what I mean by that is when I buy a stock or a bond or even hold cash in the bank, I'm earning interest or dividends, or there's some price appreciation that's on the table. There's some opportunity for growth or to earn something. With gold, that doesn't exist. It doesn't pay a dividend. It doesn't pay interest. There is price appreciation, but it's not really based on anything other than what someone else is willing to pay for it. And we can look at different economic cycles where it does differently in even like similar type of economic cycle. So it's really hard to tell what gold is going to do based on what's happening in the world. And there is some commercial application for gold. So there's some value, some inherent value there for that. But by and large, if I were to estimate, most of the value of gold is in what someone else is willing to pay for it at any given point in time based on feelings. I mean, I don't know how else to say it. So that's for me. I don't personally own any gold, and I don't include it in portfolios just because, again, I don't know how the value is, and sometimes it's a good diversifier, sometimes it's not. So if I'm designing a portfolio, I want something that behaves in certain ways during certain times more consistently than gold would.
Yeah. No.
What about for you?
I echo a lot of the same. By no means is this a scientific thesis, but it's just an observation. I noticed that Costco started selling gold like pretty aggressively this year, where every time you go into the doors, like there's the cardboard plaque with the gold bar that you can buy on it. So I don't know if like that's where there's more of this interest and appetite in gold this year. Again, just speculation, but I would agree with you. I think it's one of those things. This is kind of a funny story. When I was engagement ring shopping, I went to the jewelry store and brought Allison along, and because I wanted to know, like,
yeah,
what do you like? Like, what do you want? Right. And she was trying on like different band sizes so we could get her ring size, and looking at different cuts, and there's all the different C's, the clarity, cut, color, cost, right? Carrots. And so while she was doing that, the gentleman who was working there was talking to me, and he's like, "Oh, like, have you done much research?" And I said, "Yeah." And I'm, like, for ethical reasons, like, I'm actually probably leaning more towards like a lab grown diamond. And shouldn't have said that at the jewelry store. But he gave me this whole spiel about, how precious gems hold their value, and, it's an investment in your marriage and whatever, blah, 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 blah. And then he was giving me the cons of the lab grown diamond. And he said, well, if you ever had to sell it, it won't be worth what you paid for it. And I said, number one, if I'm in a pinch, do you think the first thing I'm going to go is, hey, honey, you have to sell your wedding ring?
He must be a different audience, Matt.
I mean, maybe. But secondly, who's going to know the difference? Like, if I were going to go, it's still a diamond, is it not? Right? It's just made in a lab versus coming out of a mine somewhere. But I just thought that was like really interesting, where he acknowledged that I would have to sell it. And then he goes on to tell me how he has like these other gemstones and he can't get rid of them. So not only is it a precious thing, but now it's a liquid and precious, and there's a lot of money stuck in there. So that's where I'm with you. Like, how do you sell it? I think that's always a interesting question. And I would have to assume you're going to go to a gold broker who surely is not going to pay current market prices, because they're going to want to make some money on that transaction. A spread on it,
for sure.
Fees, so to speak. But yeah, much with you, like, I kind of view it as maybe at best an inflation hedge, but I also think that's what a house really is at the end of the day. And you can't live in gold, as you said, right?
Unless you build a gold house.
Unless you build a gold house. But, if you're building gold houses, I don't think you need to worry about your investment return, right? So yeah, I'm right there with you. It doesn't produce anything. The future value is really what someone else is willing to pay for it, with no like data to back that up, right? If you're buying a stock and they produce, screws, let's say, I don't know, like, there's still revenue and they're always going to be making screws. This is not investment advice for screw company, whatever that
or
may
for
be.
Gold.
Or for gold. But it's just one of those things where, like, there's not really any value being added other than what someone says the value is being added. And to me, it just feels like maybe a volatility play with like gold dealers, and they're trying to, get a bunch of gold and then arbitrage it, versus like, oh yeah, like this company just has good revenue and does good business and builds things. So
yeah,
right there with you.
The other issue I have, Matt, too, is like, if I go buy a stock or a bond, I can hold it in a financial account. Whereas if I go physically buy gold, now I got to figure out what to do with it. Am I going to hold it in my house? Am I going to put it in a safe? Am I going to put it in a safe deposit box? Like, what do I do with it? How do I store it safely? Do I need to insure it? There's more that goes into that than a simple financial investment somewhere else. And the taxation's differently. Gold is, and my understanding, is considered a collectible. So I believe it's taxed at 28% in terms of capital gains, as opposed to, for a lot of people, 0, 15, or 20. So, my original idea stands, but I also think there's some other things to think about with owning gold and some complexities that go with it.
Yeah. And then, I mean, there's also like the doomsday crowd out there, right? Like
we're not trading gold.
the guns and gold portfolio, right? Like, if all goes to hell, at least I have my guns and my gold, right? What if they determine at this doomsday time that, I mean, let's look at tulips. Like, tulip bulbs used to be a huge thing. I can't remember which country it was, but it was very frothy. And one day they decided, we're not doing tulips anymore. And then a lot of people lost a lot in those times. I mean, guns different, but that's not really the topic of this podcast. But, who's to say in this doomsday scenario, we're not going back to like trading beaver pelts like we did at the start of our country, right? So that thesis to me is, I know I'm not going to ever convince those people, but sure, you got some gold bars to hang on to if that's it. But what will they be worth?
It's possible, but I see no world where other people would be willing to trade something like food or water for gold.
Right.
If we're really doing doomsday, right?
Sure.
But yeah.
And then again, too, our stocks are probably useless, but, whatever. I guess
Sure.
technically you would own the company, right? Like, so
The company that doesn't exist.
yeah. Well, some will probably survive, but yeah, to me, it's interesting. I understand like a small allocation if people really do believe in it, but I did do a continuing education on it because it was one of the topics this year with how well it's been doing. And they said a lot of the same things. Like, if you're going to own it, like, own it physically, not as an ETF, because again, if you're trying to maximize returns or maximize your profits, anytime you're using one of those instruments, you're certainly giving up spread and fees, and who knows where your gold actually is. So, like, do you really own it? Who knows? I don't know how that would all work if, an ETF fund were called to deliver gold. I'm not sure how that would go, because they probably don't have it either. It's probably stored away somewhere.
Is it being stored and secured by the same people at the Louvre?
Yeah, let's sure hope not, right? But also, it really seemed like you have to buy into this thesis, and if you don't, like, you're making a mistake. And anytime it's such a black and white thesis, shall we call it? I did air quotes for those listening. It's like, okay, so there's really nothing else to this, right? And then they were talking about like how you time it with like silver prices and how silver's a bad investment, but gold's a good one. And I'm like, I don't think there's really a thesis here at all. Like, other than you work in gold and you want more people to invest in gold because you certainly would benefit as a large holder of gold, right? So again, I don't want to like dismiss people who have those beliefs, but I think the next question is like, if you determine yes, then what does it replace in the portfolio? And that's, I think, the nail in the coffin for me. Like, on any real thesis of gold is, okay, like, sure, every year, what should I rotate out of my portfolio? And then how mad are you going to be at me when that thing that you decided to rotate out of your portfolio is the top performing asset class next year, right?
Yeah. And Matt, you've got a chart of returns that I think are worth pulling up. And while you're doing that, I mean, this is another problem that I have is gold can go through multiple decades where it does poorly. And I know as an investor, if I watch something and it does poorly for 10 years or 20 years, I like, how long am I going to hang on to something like that? You don't see those types of poor returns in really any other asset class most of the time.
Yeah. And so this chart, for those of you, I mean, watching and listening, I think there's a few decades in which gold is the top performing asset class, but it is certainly the exception and not the rule, right, Elliott?
Yeah.
And as we look at this, so it has stocks, cash, bonds, real estate, gold, and inflation across this time period from the 1930s to the 2020s. You have stocks in first place with a 10.3% rate of return. There's a very steep drop off to gold actually being the second highest with 5.6%. Then you have real estate at 4.7%, bonds at 4.3%, cash at 3.3%, and inflation is about 3.2%. So this is where, again, I get it, and there is some caveat to this chart here where Elliott made the comment before the episode that the real estate return isn't a true rate of return because you probably have some leveraged return on there. But yeah, Elliott, when you see this chart, like what jumps out to you?
There's two things that jump out at me first. Maybe a few more things like that, but you'd mentioned gold, because we're picking on gold here. 1970s, gold's off the chart, 28% plus for that 10-year period. 2000s, pretty good at 14 as well. But in between that, it has negative 2.5 and negative 3.1 for the 80s and 90s respectively. But more importantly with this, if you go back to the 40s and or 50s or 60s, and we could make an argument, maybe those economic principles don't apply now, but it's worth at least checking. a lot of these actually have negative returns after inflation. If we look at the 40s, it had a pure negative return, but inflation was 5.4. 50s, 1% return, but inflation was 2.2. 60s, 1.6, inflation was 2.5. So, and then again, the 80s and the 90s, if we count for after inflation, there's a lot of decades where after inflation, gold looks abysmal. And so if we can't time this, which I'm willing to accept, I can't time when gold's going to do well. I don't know if I can hold on to an asset that after inflation for, 50 years on this chart, right? Is my math correct there? Has negative returns.
Sorry, can you repeat that again?
I'm just saying, I think here, like if we add up 40s, 50s, 60s, 80s, and 90s, it's 50 years, not straight, but 50 years worth of data where there's negative returns in the asset. For me, like I don't have I can't hold on that long to get the 28% returns or the 14 or whatever it is. I know that as an investor.
Sure. No, I agree. And then too, you're looking right at the opportunity cost, right? I mean, look at real estate, and the times real estate does not beat inflation are far fewer, right? It's almost non-existent, especially compared to that of gold. And this is a conversation I really have with my clients before we ever start managing their assets is, look, I'm not trying to pick the best thing and go all in on that best thing every year. I'm willing to hold things that are going to underperform. But the truth is, all we're trying to beat is inflation, right? That's how you become wealthy. And exactly what you're saying, Elliott, there's a long stretch of time where gold is not. And it is that weird emotional side of the investing where if you do experience that for 10, 20, 30 years in a row, where you're just getting raked over the coals by gold, that's exactly when you're going to pull out. And that's exactly when you're going to miss out on your correcting returns, right?
Unless you put it in your safe and you forget about it.
Which, let's be real.
I mean, some people do. But I think also to add to that, Matt, like bonds, there are some decades that it underperforms. But at least with bonds, I'm getting a diversifier that historically has held up certain times and been less correlated with stocks, whereas that's not the case necessarily with gold. As I talked about earlier, sometimes it's a diversifier in a good way. Sometimes it doesn't act like people expect it to.
Yeah. Yeah. Well, and I think what's interesting too, I mean, we pick on houses a lot, right? Houses do give, in general, good return, right?
Above inflation, I'll say.
Sure. It's so good. It's doing the job. Yeah. It also provides a place to live, but it's also not a cheap investment to maintain. No. And I think that's another undersold aspect of gold. Number one, if you're keeping a substantial amount of gold in your house, right, there's real different risks, right? There's risk of theft. You're going to have a safe. You're going to have to probably insure it somehow. So I'm not saying that those are like prohibitively expensive, but it is something that I don't think is talked about at all, right?
Yeah, I think a lot of people end up putting it in a safe deposit box or storing it at home for better or for worse.
Right. Well, even a safe deposit box, I mean, what then? I don't know. I'm not the biggest fan of those, but that's probably a story for another day. But yeah, I mean, I just look at this and I see like even boring bonds historically have beaten inflation and beaten gold more times than not over these decade time periods.
Yeah.
So, all right. Anything else on gold?
I might just add, if you own gold, I mean, I know we just bashed it for the last almost 20 minutes, but I also don't necessarily see anything wrong with it. Like if you as an investor and your investing philosophy, you're like, hey, I want this allocation to gold and it works. I don't personally think there's anything wrong with that. There are portfolios out there. I won't say the specific one, but the specific one historically has done okay, and it has about 25% gold. So there are situations where it can work, but I think it's important that like having an investment policy statement of why do you own it and making sure that you stick with that through times, or when when does that investment philosophy change? And it's not necessarily just solely because of performance, but because of something in your life or some inherent philosophy. So I just wanted to add that, because if you do own it, I don't think that's necessarily a bad thing. I know people who own gold. That's fine.
Yeah, it's fine. And I'll fully disclose, I own Bitcoin. It wasn't, to make millions in weeks or months or years. It was a speculation purchase. Who knows how that's going to pan out, but I don't think anyone needs to avoid speculation. You just need to have, like Elliott said, an investment policy that puts a cap on it, right? And that's where, again, we can go to Wall Street Bets or Our Personal Finance, and you can see the people who are being wildly and recklessly speculative on any one asset class or any one specific security. And it's reckless no matter what, just as you could say the same as being reckless and just holding all your money in cash. But for the right person with enough cash, it's not reckless, because you have enough money to do what you need to do, right? So Absolutely. There is no one size fits all, but I think the biggest takeaway is asking yourself, why are you doing this? More importantly, why do you want to do this now? And if the answer is because it's doing really well, that's probably not the right answer. So dig a little deeper, no pun intended.
Well said.
To find out
gold.
Well, no, you have to dig the gold out.
Oh, okay. Yeah. I thought we were hiding in the backyard.
Oh, I see. I guess it works both ways. So
it does.
Good on you. But yeah, again, I think it echoes a lot of what we've said in the past, but it's next year we'll talk about some other hot asset class that is being talked about a lot, and the answers will be the same. So stay tuned in and use us for, I guess, wisdom and a gut check if you need it. So
sounds good. See you next time.
See ya.
Thanks for listening to this episode of the Me and Money podcast. We hope you enjoyed the show. Have a question you'd like to suggest for a future episode? Drop Matt or Elliott a question at their email, or use the linked form in the show notes. Like what you heard? It would be a tremendous help to us in our mission of having real conversations about personal finance by leaving us a review on your favorite podcast app. A few words can go a long way in connecting those looking for content like ours on their app of choice. You can also support the show by liking, sharing, and subscribing. Thanks again for listening, and be on the lookout for future episodes soon.
The Me and Money podcast is hosted and produced by Harmony Outsourcing Services LLC. Matt Fizell is an investment advisor representative of Harmony Wealth L.L.C. Elliott Appel is an investment advisor representative of Kindness Financial Planning LLC. However, the views and opinions expressed by Matt and Elliott in this podcast are not intended as individualized investment advice on behalf of Harmony or Kindness, or as tax, accounting, or legal advice. Although we gather information from sources that we deem to be reliable, we cannot guarantee the accuracy, timeliness, or completeness of any information prepared by any unaffiliated third party. When specific investments or types of investments are mentioned, such mention is not intended to be a recommendation or endorsement to buy or sell the specific investment. Harmony is a registered investment advisor authorized to do business in the states of Wisconsin and Texas and other jurisdictions where exempted. Kindness is a registered investment advisor authorized to do business in Wisconsin and Washington and in other jurisdictions where exempted. Registration as a registered investment advisor does not imply a certain level of skill or training. This website contains links to the Harmony and Kindness websites that provide general information about the advisory services offered by Harmony and Kindness. These links are provided as a convenience only. Harmony and Kindness can only provide individualized services after you sign an agreement and receive required disclosures. Users of this website may, but are not required to, engage the services of Harmony or Kindness for advisory services. Please remember that all investments involve varying degrees of risk, and the future performance of any specific investment or investment strategy is not guaranteed to be profitable or equal to any historical performances. As a final note, we'd encourage you to reach out to your financial professionals before implementing any of the strategies or concepts discussed in this podcast. Thanks again, and we'll see you next time.